Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's YouTube video. The last video I did, I mentioned that I don't like the topic of tax in general, negative gearing, tax deductions, anything to do with accounting or tax when it comes to property investing is not my favorite topic. My favorite topic is choosing the best performing properties and making money. However, having said that, this is a very important topic that I want to unpack with you today because it means the difference between you having a property that's cash flow negative or cash flow positive, and also has a great impact on your serviceability and ability to buy multiple properties. So sit back and relax, grab a coffee, and welcome to today's topic, which is how to maximize investment property tax deductions in Australia. And this is going to be a bit of a topic which I won't do myself because I'm not an expert on depreciation schedules. So I've got none other than Brad Beer from BMTQS who'll be discussing this with you today. I want to just cover the principle of tax deductibility with you before I get started. Now, a bit of a disclaimer, I'm not here to give you any financial advice. This is purely educational purposes only. I've never met you before. I'm not aware of your risk profile or your financial standing. Having said that, Brad Beer, who'll be speaking and doing majority of the presentation today on quantity surveying, depreciation schedules, and tax deductions, is a qualified expert. So he's qualified to discuss depreciation schedules with you and tax deductibility when it comes to investment properties. I've been using depreciation schedules pretty much from day one. I'm actually surprised people don't use them. So I'm going to unpack that in detail today. Before I go any further, for those who've never listened to me before or don't know anything about me, my background is fairly conservative. I've got a YouTube channel. I've got a diploma in financial services, financial planning. I'm also a mortgage broker, real estate agent, and I've got a bunch of other degrees, which I won't mention. The most important thing, guys, is that I'm a property investor right here in Melbourne. My entire property portfolio is here. And with the exception of a couple of houses that I own in Queensland, but I'm a multi-million-dollar property portfolio investor. So I'm actually doing it myself. This is not theory. This is all practical advice that I want to share with you guys. And the whole purpose of my YouTube channel is to optimize your profitability and make you guys successful. I have no vested interest in making any suburb or any strategy look better or worse than it is. I'm not a developer selling my own stock. I'm not peddling any particular strategy. I'm just sharing what works with me and with other clients, and then you can choose and pick any information from these videos and see if they're applicable to your situation and your specific set of circumstances. By the way, I want to really thank you guys for buying my books, even despite the current economic climate and people are really cutting back on costs. And I'm going to do a video just on how hard it is to live in Australia at the moment because people are really struggling with energy prices, fuel prices, insurance prices, just everything. Inflation's out of control. And, you know, book sales are record low in all sectors of the industry. But interesting enough, my book is still selling record high. And I've been number 1 and 2 and 3 in multiple categories on Amazon, both my finance book and my real estate book. And Amazon and a couple of other publishers have come back to me and said to me that one of the things that people are really reading about these days is mortgage reduction programs, how to save money on their mortgages, how to structure mortgages, and personal finance. So I'm kind of a little bit not surprised that that's a good topic to be informed about, especially when you're trying to save money and maximize every dollar that you earn. So, but I really want to thank you guys for buying my book because, you know, it's one of those things, as I mentioned all the time, when you publish your book, apart from your mother buying the first copy, you don't know if you're going to sell any copies. So I really want to thank you guys for supporting me. Yeah, if you want to get a copy of my book, by the way, directly from me, you can go into realestateMadeSimple.com.au. You also get an online free video course, or bookonfinance.com.au for my finance book. Enough of that shameless plug. Now let's get into the topic. So let's talk investment property tax deductions and depreciation schedules. In the world, nothing can be said certain except death and taxes. Benjamin Franklin. It's so true. You know, death and taxes, as they say, they're the only things you can guarantee in life, and you can't defer them. Well, you can defer taxes, but eventually you got to pay them. You can minimize them. I think with death, it's actually harder to cheat death. I know people are trying in different ways. People getting frozen and hoping to get revived one day, and all sorts of, amazing medical wonders and potions and strategies to make your life go longer and longer. But it's one of those things when it comes to property investing, taxes are important, because the key thing is, as Brad Beer will unfold and unpack later on when he speaks, the OTO doesn't differentiate between real expenses and depreciation, which is amazing. I'm going to cover that in detail. So the best company that I've used over the years for the depreciation schedule, and look, guys, I've used pretty much all of them. I've been through about 10 different companies that provide depreciation schedules. BMT quantity surveyors tend to provide the largest depreciation schedules. Historically, depreciation schedules could have been prepared by your accountant. Now that has changed, well over a decade now, where they can't do that anymore. It's too complex. There's just simply too many deductions you can claim, and it's too much of a specific thing that you need to be aware of. But what is a depreciation? What is tax depreciation? Let's get back into the basics. I'm just going to give you some ideas and terminology before we start to unpack the topic. Tax depreciation and tax is simply tax deductions claimed for the natural wear and tear of an asset or an income-producing building and an asset over time. It's generally the second biggest tax deduction for a property investor after interest. So it's like if you've got lemonade, if you've got a business of selling lemonade, you've got the lemonade stand, obviously, and then you've got to buy ice, lemons, and water, and then you can depreciate the stand. You can claim the cost of the lemons and potentially ice as a tax deduction, and then you have profits. I mean, tax deductions are the fabric of capitalism, so it's not something we're doing here where that's dodgy. It's actually your given right to claim the maximum legally allowable tax deductions you can claim when it comes to property investing. And why wouldn't you? You're leaving money on the table. It is crazy. And I'll show you the difference between structuring your tax deductions correctly and incorrectly and what it could mean for you long term. Now, who should I claim? Claiming tax depreciation reduces your taxable income, meaning that you pay less tax, which I know everyone wants to do. You may be eligible for thousands of dollars in depreciation deductions each year, and I'll show you some really cool examples in a second. Tax depreciation deductions allowable for both residential investment properties and commercial buildings. Most properties, new or old, have depreciation available. What can I claim? You don't need to spend money to claim tax depreciation. Tax deductions are split into two categories. So you have Division 43, which is capital work deductions, and Division 40, which is your plant and equipment, which are fixtures and fittings. So basically, you've got two kind of things. You've got a house or an investment property, which could be a house, a townhouse, or an apartment. You've got the actual building, and then you've got the internal fixtures and fittings. So capital works, which is Division 43, is available for the actual building itself. And the key thing is here is the building has to be constructed after 1982, and you can only depreciate the building over 40 years at 2.5%. And Brad will go through the history of this whole depreciation of buildings and how it changed over time. I don't want to steal his thunder. Plant and equipment is basically fixtures and fittings, and most fixtures and fittings kind of have a lifespan of about 1 to 15 years. So like carpets could be 12 years, a hot water system might be 6, 7, a dishwasher might be 5, air conditioning heads could be 5, and you get to depreciate them. So what quantity surveyors do is they basically go into the market, they work out the actual market value of items, like what is an air conditioner right now. And I'm talking about a specific make and model, because air conditioners can vary from, $800 for a basic model up to $3,500, depending on how many kilowatts and the size of the air conditioner and the brand also. You've got cheap Korean brands, you've got high-end German, Italian brands, so, and everything else in between. So obviously there's a price variance. So that's why with quantity surveyors, they're specialists in not only understanding depreciation of certain items in your property, but also the life of how much you can depreciate. And generally speaking, there's two types of depreciation types you can structure. You can have either diminishing value for fixtures and fittings, which means you get more upfront, which is kind of what you want, because as your rental builds up, you want that property to be cash flow neutral or cash flow positive as soon as possible. Straight on depreciation is more applicable for people with higher incomes, where you have the same depreciation over a longer period of time. So for most of my clients that buy properties, we're doing diminishing value depreciation for fixtures and fittings. Building depreciation is just 2.5% over 40 years. So capital works, which is building depreciation, refers to the building structure and items that are permanently fixed to the property, such as kitchen, cupboard, doors, sinks. Capital works make up between 85 to 90% of the claim. There are different rates of depreciation available for different properties based on type, industry, and construction. So with townhouses, pretty much the townhouse and the common area. The detached house is pretty much a detached house. With apartments, though, the advantage is not only do you depreciate the apartment itself, so let's say you're in a 2-bedroom apartment and there's like 30 of them, but you also get to depreciate a percentage of the common area and underground car parks. So if you have underground car parks, which are very expensive to build if they're going underground, especially with lifts and commercial grade air conditioners, you get a percentage allocated based on the percentage of the footprint that your apartment represents based on the whole footprint of the property. So for example, if you have, let's say 50 apartments and the block that it's built on is 1,000 square meters, you can work out the mass of how much you can claim in terms of the common areas. You get massive depreciation on things like air conditioners that are commercial grade, swimming pools in common areas. But once again, with apartments, guys, be careful. And I've done a number of videos warning you not to get involved with apartments in Melbourne. It's not time yet. It will be in the future. At the moment, there's no guarantees that if you buy a 2-bedroom apartment, you'll make any money in the next 2 years, 3 years. And that's a real concern, especially that we're heading towards the peak of the rental market and the property cycle as well. So it's interesting. So you can claim things like windows, doors, locks and handles, bathtubs, swimming pools, car parks, ducted air conditioning, sinks, toilet bowls, and brick and mortar. That's your building depreciation, basically. And the ATO says if you buy a building, whether it's a townhouse or apartment or a house, it has a lifespan of about 40 years, and then it's basically scrapping value at the end. So you can, these are the deductions you can claim, which is pretty cool. And this is kind of money in your bank account because it reduces your income. And remember, your income is based your job income and your rental income. So these are things that you're getting claiming as a tax deduction, lowering your income, meaning you get a more income back from the ATO, which I'll show you exactly how that works. And Brad's going to go through specific examples with you on properties that my company has sourced for investors. Plant and equipment, Division 40, are items that are removable from the property, like carpet and blinds. These assets have a limited effective life set out by the ATO and can generally be depreciated over time. Investors can claim depreciation deductions on more than 6,000 different ATO-recognized plant and equipment assets. 6,000. That's why it's such a specialized area, guys, and that's why the ATO decided a long time ago that it's no longer relevant for accountants to do this. It's just too specialized, and they developed this whole industry of quantity surveyors who create depreciation schedules, who are the only ones now legally that you need to use in order to claim tax deductions for up to 6,000 items, which is huge. There are some restrictions of claiming depreciation on previously used plants and equipment found in secondhand residential properties legislation from 2017. So in Melbourne, for example, if you're buying a property that is secondhand, even if it's one day, post May 2017, you can't claim depreciation on fixtures and fittings anymore, only on building depreciation. That's why I only source brand new properties for clients, whether it's townhouses, detached houses, or apartments, because I want them to claim depreciation on fixtures and fittings, and I want them to continuously upgrade fixtures and fittings, i.e. kitchen, cabinetry, carpets, paints, all that stuff in the property to get the maximum rental, because rental is the fuel for your property portfolio. Rental is your oxygen, guys, when it comes to property investing. Remember, when it comes to DSR ratios, which is your main serviceability ratio that the banks out there use, they generally take 30% of your job income and 80% of your rentals. So if you're on $100,000 as a let's say the employee, they only take 30 grand of your income towards serviceability of debt. If you have 100,000 rental income, they take 80,000. So, pardon me. So rentals are 3 times nearly heavier in the serviceability equation than job income. That's why you want to maximize your rentals, because they will enable you not just to have an easier life because you're spending more on your property. Also, the biggest thing is that it's going to enable you to buy more property quicker and create financial independence in your life. So I can't overemphasize the importance of claiming and maximizing tax depreciation and deductions on investment properties. The things that you can typically claim when it comes to fixtures and fittings are blinds and curtains, security systems, light fittings, hot water systems, chairs, cash register, commercial ovens, hot water systems, ovens, canopy, all that kind of stuff. And I definitely recommend you maximize the depreciation on those things. Otherwise, you're leaving money on the table. So range hood, stove, fridge, if you have a fridge, if it's a rental property, a lot of the apartments that I've sourced in the past around St Kilda and Elwood, I encourage a lot of people to put in plasma screens into the living area and bedrooms because they can depreciate them and get them cheap at Aldi and claim massive depreciation and also increase rental. Kitchen cabinetry, smoke alarms, things like that, dishwashers, obviously. All those things can be depreciated and you can claim that back every financial year, either through a lump sum at the end of the year or what's called an income tax withholding variation form, which coincides with every pay cycle. Remember, employees pay the highest percentage of taxes. Big businesses and investors pay the least. Why? Because they're smart, guys. They use the system to their advantage. And this is the biggest thing that I want to share with you today in terms of the psychology before I let Brad take over and explain this in detail. This is the main difference between the rich and the poor. And if you get this fundamentally, it will change your perspective on investing forever. So this is what happens with rich and poor people at a fundamental level. Poor people work, now everyone works, but let's say, and I'm using the word job just over broke generically, they pay taxes. So poor people, they go to work, they pay taxes, they get paid. So their pay comes in after the ATO grab their little bit of income, whatever it is, depending on your marginal tax bracket. Then they spend 100% of their money. They use credit cards, personal loans to top up their habits, which is car loans, credit cards, personal loans, and they try to invest post-tax dollars, which doesn't work. And that's why they complain. The difference between the rich and the poor is the rich work or earn. Usually they don't have a job, they own a business, or they're self-employed, or they run a company. They get paid, but before they pay taxes, they invest with pre-tax dollars. They buy investments with their pre-tax dollars, and then they pay taxes on what's left over, and then they spend, and they take responsibility for themselves. So the biggest difference, guys, is just one step. But if you get this can change your whole paradigm on investing, is the poor buy investments with their post-tax dollars. The rich buy investments with their pre-tax dollars. So they buy investments and then they get taxed on what's left over. The poor get paid, they pay taxes automatically, and then they spend everything on lifestyle, and then they're broke, usually 2 or 3 days without income, waiting for the next paycheck. And there's never enough paycheck at the end of the month, which is what they find. So sit back and relax. We're going to watch a quick presentation from Bradley Beer from BMT Quantity Surveyors talking about depreciation schedules. Now, this is a video taken from my Property Portfolio Accelerator Summit 2022, which is a 4-day boot camp that I run from time to time, kind of every 2 years for high-end, for high-end investors who already have 5 properties and want to go to the next level. And you could also get this as an online video course as well, which I'll talk to you about after we come back from the video. The 4-day boot camp was quite amazing because we had a whole panel of experts, and this was the first time I got everyone in the same room, which basically is exactly what you need if you want to become successful in property investing. You need a panel of experts that are smarter than you, more successful than you, and have clients that have more properties than you. That way they can take it to the next level. You remember there's a Polish saying, how can I soar like an eagle if I'm surrounded by pigeons? So one of the most important distinctions that I've picked up in my 48 years of being alive is if you want to become successful, you have to hang around with successful people, but also you want to be the dumbest and poorest person in your network. Because if you're the richest and smartest person in your network and you have the current results that you have, you're in trouble and you need to upgrade your network. So the easiest way to upgrade your network is just to find them. And these, I'm talking about obviously financial planners, accountants, lawyers, all the experts that were speaking at my Property Portfolio Accelerator Summit 2022. Now we're going to hear from Brad Beer from BMT. He's the founder and owner of and CEO of Quantity Surveying BMT. And it's a great presentation, and I'll let him take over right now. I'll see you shortly after this video.
Great to be here. Love talking. I've been out there talking to some of you guys at the moment, asking me all about tax depreciation and inspecting properties. That's a great one. We'll get into that today, absolutely. And I love property. I'm an avid property investor. For 2002, I think I bought my first property, which I still own basically everything I've bought on the way, and developed a few little ones on the way as well. And it's been fantastic. It's made some good money over the time, which is great, and I still love it. It's great. I love having those discussions out there right now. I've been in BMT for 24 years. I am the CEO and 80-odd% owner of BMT. I've got some internal guys that also own a small percentage of it. Haven't always been the owner. That's only a recent addition. I was a smaller percentage owner until recently. And I started as the first staff member in that business under the guys that started it, became their partner in 2002. So I was at uni learning about quantity surveying, didn't really know what a depreciation schedule was, and I went to get some work experience, and here we are 24 years later. We now have done, in June, we clicked over 800,000 depreciation schedules in that period of time, and we've got about 180 staff, and we do these all over the country, and we do visit them to get the maximum out of them, which we'll touch on later. So there's a little bit of background. One great thing that I've had over all that years has been from very early, probably back in 2000 somewhere, I went and talked to people about tax depreciation that were learning about property. I'd often sit through the days, and I've been able to formulate strategy and learn from that at the same time while I'm the depreciation expert. So I think what I'm going to do today, we've got a good bit of time, which is great. So, Konrad assures me that you love detail, so I've got a fair bit of detail. I'll try not to give you ridiculous amounts of that, but let's get into the concepts of what it is, why it's there, and really, I buy property not just for fun. I like to make money from it. We make money through growth over time. We make money through cash flow. This non-cash deduction makes a big difference to the cash flow. So let's show you how, and a little bit about how we do it, and some tools that you can use to help you in the journey, I suppose, on the way. What is it? We all understand depreciation when we talk about cars, so that's probably one of the easiest things to mention. We buy our car, and pre-COVID, although that doesn't seem to happen anymore, pre-COVID, we used to drive it out of the shop and it was worth less money and it was depreciating, right? Things have changed a little. I think a Land Cruiser second-hand costs more than a new one now, but anyway. The concept is still there. It wears out or it declines in value over time. If you use that car for business, you get to claim the deduction for that. Property, similar. The carpet, the stoves, the bricks, they wear out over time. They depreciate or decline in value. Tax office allows us to claim a deduction against that wear and tear over time, and it's a significant amount of money. Where it becomes a bit difficult sometimes is people say, I'm buying property for it to appreciate or go up in value, but which, if we get the right thing, it does, and we hope so, and that's how we make money from them. But the carpet still wears out, the bricks and mortar still wear out, and the tax office allows us to claim that deduction against that, basically. Makes a big difference. And then it's the second biggest deduction you get to claim against the property usually. Interest is first, that one's expensive. Depreciation the second one, but the depreciation is better because you don't have to pay for it, basically. Well, not exactly. Where do I need to point this thing? Why does a quantity surveyor do it or get involved in it? So I'm not an accountant. I do have a tax agent. I'm a tax agent for the purpose of depreciation, but I'm not an accountant. I'm a quantity surveyor. Traditionally, a quantity surveyor is someone who, so I did a building degree, not an accounting degree. The guys I went through uni with do, project management, construction management and things like that. We come out as a specialist in measuring and costing buildings. So we would get involved in construction projects when someone's thinking about costing it, thinking about what it would cost to build. When the builder wants to know how many bricks to buy, he could get a quantity surveyor to measure them for him. When the bank wants to loan a developer money, if it's more than $1 million in construction, they don't just loan it to you. They want to get a quantity surveyor to make sure you can build it for $1 million or $20 million. And then they don't just give you all the money either. They give it to you over the course of the project. And a quantity surveyor will go, okay, They've done the first $7 million worth of work. They need another $13 million to finish it. So we hold on to, it's all about cost to complete actually. The bank always holds enough money to finish it. They don't care what you spent. They just want to make sure they can finish it. And the quantity surveyor would go each month and look at the building, look at how much work's been done, look at how much work is left to do, and tell the bank, you know, you need to hang on to $13 million so you can finish this, basically. So all different times in construction we'd get involved. BMT, we've concentrated on the depreciation bit, have done the other bit, don't like counting bricks that much that way, and colouring them in. So there's a compliance piece. The ATO says that they don't, they want some actual costs or some estimated by a relevant professional such as a quantity surveyor. Quantity surveyor is not the only guy that knows how to estimate costs. If you're a builder, you've been building 3-bedroom houses for 20 years and you say it should cost this, you should know. That would stack with the tax office. But we are one of the cost experts that they will accept the cost estimates for. So compliance, your accountant doesn't estimate, your accountant doesn't have coloured pencils, right? Doesn't count bricks. Neither does your valuer. Good point. Valuers sometimes have some quantity surveyors. They do some depreciation schedules, and just the valuer is not a quantity surveyor. Different science. They pluck numbers out of somewhere, and we actually, you know, measure bricks. Sorry for the valuers in the room. Then it comes down to knowing the rules. So there's knowing how to count the bricks and come up with the right numbers, which is compliance, and then knowing the depreciation rules and making sure we apply them properly. So just because you know how to count the bricks doesn't mean you know the depreciation rules. Just because you know the depreciation rules doesn't give you the right to count the bricks effectively. The accountants are our friends. We work alongside them. We're not accountants, but they're friends. Industry qualifications, you know, we all need to have those. Ours is the Institute of Quantity Surveyors. I'm a member, associate member. There's a big review of the way quantity surveyors do depreciation schedules going on that I've had a lot of input to with them at the moment, so we can try to get our industry, you know, making sure they're doing it properly. We probably have half of the market of depreciation schedules in the country, roughly. So they're my friends, and so we try to clean up the ones that don't know what they're doing where possible. As I say, tax agents for the purpose of depreciation schedules, not to do tax returns, but there's a department that we have to do that. I'm also a plant and equipment valuer, so we can value plant and equipment for the purpose of, you know, larger depreciation stuff sometimes. Now, I think the easiest way sometimes to see what you know, this is a deduction, it's worth heaps of money, I told you, that's great. How much and how, if you don't know how to run a cash flow on a property, you probably should if you're going to invest in property. I'm here to go, well, what happens if I do or don't claim depreciation? The rest of it is the accountant or the worker, whoever's domain. I know how to run the numbers, obviously. So we're going to run through and see what happens. And we've actually pulled some examples that Konrad gave me of properties that they've got or they're selling or they've sold or whatever, whichever ones that he gave me, said this is how much rent we get, etc. So I've run some depreciation against those particular properties and what we think it would look like. So we can see what sort of cash flow it would look like if we do or don't claim depreciation, basically. Interesting fact from some research we've done in the past, around 70 to 80% of investors that have properties, maybe not as educated as they should be sometimes, don't maximise this deduction. So they don't claim anything, but they don't maximise it. So a big chunk of the time they're just leaving money at the tax office because the mate at the pub said it was too old, they thought their accountant looked after it and didn't. They used the one from the builder that was cheap and nasty. and look, that happens, and we're expensive in that part of the market where we're doing lots for the same builder. But we want to go out and have a look at one. We don't just take the spec list and add some numbers to that because we want to find everything, get everything we can out of it, basically. Not going to cut the corners because I don't get the maximum deductions by cutting the corners. That's my job. So, 2-bedroom townhouse here, Wood Street in Mornington. 2 bed, 2 bath, 1 garage, $695,000 purchase price, rental of $580 a week. What's it look like? I've got a pointer here somewhere. I'm any good at IT? Yeah, there we go. So we're going to have an income there of about $30,000 for the year after that rental. I'm happy to give these slides away, by the way, and I'll have to disclaimer these because I'm not an accountant, but anyway, happy to give them away. But let's see what the numbers look like. $30,000 worth of income, $36,000 worth of expenses, and you can see we've, rates, management, strata fees, etc., loan interest, etc. added them up on a 90% LVR at 4.5% per annum, comes up with 36,540. Whatever those numbers are will change based on what your interest rates and things are and your LVR, etc. But we've made some assumptions there. So what that means is that this property is going to cost us $6,380 per year to hold on to, or $123 per week, pre-tax, pre-anything, right? Not great, $120 a week. We do get a refund for that. I think we've had some discussion around negative geared property and whatever it is, and the deductions available. We'll make a deduction for our $6,380. Tax office gives us some back. A lot of property investors sit in that 37% marginal tax rate, get $2,361 back. Our outlay for the year goes from $6,300 down to $4,019, or about $77 a week. Simple, we paid out the expenses, we got some income, $77 a week to hold it. If we claim depreciation on this, which is the only difference on this side of the page, $12,437 on that townhouse there is what we believe the first year's deduction would be. We now make a deduction of still that $6,380 plus that $12,437. Our total tax loss now is $18,817 for the year. The difference, like we've already kind of touched on, is that this one you pay for, this one you don't. Your carpet's wearing out, your bricks are falling over one day, etc. Now there is a CGT thing we'll talk about later, but you don't pay for it, you do your tax, you get $6,962 back at the end of the financial year. If you're on this marginal tax rate, this probably now gives you $11 a week in the pocket after your tax return's done, as opposed to costing you $77 on the other side of the page. $88 a week is the difference in claiming or not claiming depreciation. Not a highly difficult scenario. I've got a little app that can help you crunch these on your own properties, but when you work out how to run those numbers, they're fairly simple. When I say they're simple, once you learn the way to do them, etc., then I don't know, I can afford a few more of those than I can of those, I suppose. It's fairly simple. Depreciation was the good bit, of course, though. That's how it all happened, or some of it at least. Then we obviously want to buy the right ones so they go up in value, etc. But the cash flow situation, providing you've got the money to write off the tax against, works much better with the depreciation. Another scenario here. More expensive property, $1.425 million in purchase price, 3-bedroom townhouse, $900 per week. Yield not quite to the same level. I think we've run through the type of scenario and how it kind of works already, but at 37.5% cents in the dollar, well, it was first costing us $15,000, after the refund $5,500, depreciation $26,000, more expensive construction cost, etc. Tax refund $15,000. It still brings it back to being a positive property because the depreciation is quite high, because the construction cost is high, etc. There's 123,000 deductions over the first 5 years out of this property. So this isn't the same every year. It will slightly diminish as time goes on because of the way it's claimed. But we'll get into a bit of that later. I'm running the scenario on the first year. But there still is 123 in 5 years and 785 over the 40-year claims for that property in total is what you get to claim. $192 a week, depreciation or not depreciation. Like depreciation yet? I do. It's good stuff. Gives you money. I've run another one here just for complete same property. What happens if you're on the full marginal tax rate at 45 cents on the dollar? So we've still got all so you can see the top half of the numbers didn't change there, 41,987, etc. We've just come down here and we've got a different tax rate at 45 cents on the dollar there, basically. So, you know, 15,000 turned into 6,700, $159 a week. Depreciation at the 26, the same number as before. Because we've got a much larger percentage of tax write-off here, then we end up with a cash flow of $3,800 a year or $70 a week. $230 a week difference by claiming depreciation. The only issue we have here is unless you're making millions of dollars at full marginal tax rate, you end up running out of available tax deductions to use, of course. But these things hopefully are a point in time as rents go up over time and debt shouldn't keep going up over time, then your cash flow from the rent should help to balance out the decreasing depreciation over time, basically. A couple of scenarios there. I've got an apartment, just once again, quick here, but they're properties that the guys have got that are ones that are scenarios that you may see or have or buy at a later date. $800,000 purchase price, $700 rent, so it's about just under 5% yield, I guess, to start with. This one works out pretty good, from minus 76 up to plus 51, and that's at the 37% marginal tax rate. So they can work out okay. $74,000 in the first 5 years, $370 over the life of the property, which goes for 40 years. So some deductions there, they come out all right. Once again, you can have these to look at. Newcastle land package, $776 purchase price, $450 rent. Rent's not quite as high as a percentage, so it doesn't work quite as well. It's still negative after, but we go from from 15,000 down to 5,600, $180 a week down to $67 a week, 71 the first 5 years, 385 over the first over 40 years. Still $119 a week difference. The reason that this is the investment that's possible might be different. It's got some land, maybe they're thinking better growth, etc., but different ones that obviously you've got available there. House and land package, different one again, $685, $420 rent, $147 down to $39, $108 a week difference, $350,000 in deductions over the period of time. So a few scenarios there. You can have all these afterwards that we've run, but you want to run them on your own, tax rates, etc. So I've got a tool that I'll give you, that it's an app that's free you can use later to come up with those numbers. Now, how does it all work, I suppose? How do we come up with these numbers? Let's get into some technical stuff about it. Depreciation's got two areas that you claim for, I suppose. One is what's called the capital works deductions, Division 43, used to be called Division 10D. If you're old, you'll know that one. Some accountants still call it that. This is the hard stuff, the structure, the concrete walls, the floors, the roof, the things that last a long time. This is 2.5% of the construction cost. I keep looking up there, I've got the numbers here. It's kind of handy, isn't it? 2.5% of the construction cost at the time it was built. So, to take a simple example here, a house built in 2015, where its structural part costs $300,000, gets 2.5% per year, or $7,500 per year, and it gets it from 2015 for 40 years. So it gets it till 2055. Is that right? Maths is good today? So $7,500 per year. Same amount each year. It's based on the cost of when it was built, not the cost, nothing to do with when you bought it, what you paid for it, this piece. This is pure construction cost when it was built. If you buy this house now in 2022, someone else had that 7 years, could have been owner-occupied, doesn't even get to claim it. Irrelevant. What it is that you start getting your $7,500 per year from when you buy it. So you've got 33 years left to go. 7's gone, 33 to go. So you buy a property that's 2015, that's how that structural component works. New property, existing property, and is available to renovations. So if you buy a property that someone has built in, people say, I've got a property someone's built in 1930. Any depreciation in that? I don't know, is the original kitchen still in it? I hope not. Is the original bathroom still in it? I hope not. Wouldn't be the first time, but anyway. If someone's done renovations, additions, someone's built a new room out the back 5 years ago, then any of this structural sort of component gets this 2.5% against the cost of it at the time it was done. So what we're doing when we look at these properties and we visit these properties, we're looking for renovations, we're looking for the work that's been done, taking enough information to cost that to make sure we include it in the depreciation schedule that we do, of course. Now, in order to claim this deduction, there is a date thing. I kind of want to say, don't worry about dates and age. Obviously, new gets the most, nearly new gets a fair bit. After 87's important. But if you've already got it, don't think, oh, it's too old. Because remember the 1940 with its original kitchen and bathroom, if it's got that? Like, don't worry about age. We're all getting older. Don't worry about the age. It means maybe less deductions, but don't assume based on age it gets none unless I tell you that. If I tell you there's nothing there, there's nothing there. But don't let age be a barrier, but I will give you the dates as long as it doesn't mess with your mind too much. So this deduction for the structure, the dates are based on when the construction is commenced. So when you get into these dates, and they're a long way ago now, but if it was commenced in 1986 and finished after that date in 1987, then you would trigger a 4% deduction for that component. even though it finished after this. But when it starts, and then your deductions start from when it's completed. So if it's a residential house, and there's one that's built in, so this 4% bit's only 25 years, so it's run out. So we almost might as well take that off, but then I'm leaving out the technical stuff. In order to claim this deduction against the structure, it needs to be built after 1987. So a house built in 1988 has got 40 years from 1988 at the construction cost when it was built back then, effectively, to claim. Then if you're looking at two houses in the same street, one's built in 1988 and one's built in 1986, and they're otherwise comparable, buy the 1988 one. If the price is everything else is the same, obviously, is what the answer is to that. Otherwise, this structural components applies to anything that's been built after that. Obviously, usually, and especially now, construction costs go up over time. They rarely go down. They go flat sometimes. So a house that's built in 1990, 1995, etc., generally costs a lot less to build than one that's bought now. Hence a new property, because it costs more to build. It's new and shiny like the car, I suppose, gets more deductions out of that structural component. Non-residential, travel accommodation, etc. Well, I've got a little bit of stuff about the commercial side of things today and business here, which we'll go through a little bit quicker, but obviously the different types. And I guess the key one there is probably if you're into commercial non-residential property, this deduction actually starts from things built from 1982, so it's a little bit longer. The other part, called plant and equipment. Chattels, fixtures and fittings, depends where you live. Chattels in New Zealand, I think. These are things like carpets, stoves, hot water services, blinds, air conditioning systems. Things that don't last as long. Tax office puts what's called an effective life on them. It says we'll claim them over that period instead. So, it says that in a residential property that's used for rental, that a dishwasher, for example, why don't I use the ones on the page instead of making one up myself, should last 8 years. So you kind of get to claim it over 8 years. Dishwasher at $1,360 gets 25% in the first year, so $340 in the first year. That's calculating on a diminishing value rate. There's actually two methods to claim diminishing value prime cost. Didn't do a lot of detail on the difference between these, but 8 years times 340 equals more than 1,360 for anyone that's good at maths here. The prime cost rate is basically 1,360 over 8 years, evenly, which is it's just the slow way to claim it. I don't like the slow way, I like the fast way, I like more money now. I'm not even that young. I am young, but so the diminishing value is a higher percentage and it claims based on what's left each year as opposed to just spreading it out over the 8 years. So we run all the types in there. Diminishing value is a method that just gets more deductions in the early years, so that's the way we run it. We'll do a little bit of detail on that stuff in a moment. Now with this plant equipment, there's no 1987 date, but there's a few things that happen. So I'll pretend I'm back in 2016 before they changed legislation, and we'll talk about the legislation in a moment. From in 2016, I would say that plant and equipment, there's no special age date, there's no 1987, but if your carpet's from 1946, it's not worth anything, right? The rules were, a second-hand market value on items, so if it's 3-year-old carpet, 7-year-old carpet, we'd look at the condition and put a value on that carpet, and you claim a deduction based on that if it was second-hand. So that worked because there was no, it runs out, no 1985, like, a 25-year-old lift in a building that's been kept up to date and works as a plant equipment item. It's high value item. You get a piece of that in the common areas and you get some deductions for that lift. Now I'll move myself back to after 2017 when I was in Canberra at a budget dinner and choked on a steak while I'm sitting on a table as they announced changes to depreciation. I think I was the only guy choking on my steak because not enough people knew. But anyway, they made some changes to legislation and they now say that if the plant and equipment is second-hand or previously used, you don't get to claim deduction for it. So anyone that's bought from that night gets no deductions against the plant and equipment if it's second-hand. So that meant that a second-hand property, the gap in claims between a new property and a near-new property is higher. So if we look at this one here, in a say a $700,000 unit, We say the first full year under if it was new, would be about 14,600. If it was now 2 years old, it would be about 8,200. Prior to 2017, that number would have been 13,500 or something like that, basically. So because all that plant and equipment that's second-hand now gets suddenly assigned a zero value, which doesn't make a lot of sense, by the way. It's like saying, I bought a car that's second-hand, so it's worth zero, basically, but I don't know. I don't make the rules down there. Some people with lots more brains than me obviously do. This change, the only change is that second-hand residential, second-hand assets, which is not a great change. Everything else is the same. So you still get the capital works, which makes up 85 to 90% of deductions over the 40 years, but you get a bit less in these early years when that plant equipment would be there. New stuff's no change. If you buy and add things to the property, no change. You still depreciate the stuff you add to it. You just can't get it on previously used plant and equipment when it comes second-hand. If you live in your house, something like 20, depending on the year, 20 to 25% of the properties we actually do a depreciation schedule, someone lives in first. And I guess that's home buyer grants, or 20%, I think last year's figures were, but it ranges around that sort of number. If under the current legislation, if you buy a house, and just things to consider, if you buy a house and you live in it first, and then you move out of it, all your plant and equipment as an investor is second-hand and you don't get to claim it. So that is a change that came in there. So you know, lots of home buyers grants in the last, I don't know, seems like forever for first home buyers. It's sort of got a bit negative in respect that you'll actually lose your deductions against things if you move out of it later, you know. Lots of people get the grant, do the 6 months, move out, depreciation's not as good as it was. I mean, it's still depreciation, but it's 8 instead of 14 the second year effectively, or whatever the number is, not quite because that's 2 years old, but anyway. Commercial properties, no change. So when we're looking at properties, we need to make sure it's a valuable exercise for you to do it, but we always, and we had questions out there before, you know, what if it's not worth it, what happens? We have a look. When did you buy it? What did you pay for it? Is your carpet from 1927? Is your kitchen from 1940? We have a look at the photos we can see. We have a look at what we can claim, what we think we can claim. We've done 800,000 of them. We've probably done one similar at some point, or should have an idea. And if we're not sure, we think it's worth it or it's not. We'll give a guarantee and say, if we don't find deductions in the first year that are twice what the fee was, then we just walk away and don't do it. Like we tell you, no, look, it's not going to be worth it. Even if we've done the inspection by then, if we told you we think it was worth it and we've actually been out and looked at it, we still just walk away because my guys should ask a few more questions and see a few more photos. But we've done enough to get that right. We rarely have to give that back because we'll tell you at the start if we think it's not worth it and not go through the exercise, basically. So no concern about old properties and whether it's worth it. So I drum it all day today, well, the time I'm here anyway. Old property still gets deductions, may not get as much. Talk to us first before you make that decision. Out of interest, the claims in the last 21-22 financial year, what did we get? About 35% of them were brand new with an average of 15,300. And we can see the difference in stats there. So these pre-87 with that no Division 43, lots of pub talk would have said it's not worth doing. 11% of our jobs last year, an average of $5,400. Lots of accountants would have said, nah, it's pre-87, don't worry about it, right? 11.8% of our jobs, and that's a fair few jobs, and $5,400 the average first year claim. Now, these being old, some of them they've probably had some renovations at some point and some work being done, etc., whatever it is. The fairly new ones, 8,600, we can see that it's a fair chunk here in the 03 to 2015, but obviously new is the biggest in that year. In contrast, I just got the stats, it's actually 1920, they only came out last week actually. 3,800 is the average claim for depreciation that the ATO has in the same year. Now, that's not a direct comparison though, because that's who claimed depreciation. This is the jobs I did. Someone who puts in a stove in their house and claims depreciation for it and nothing else, they'll be in that figure and not in my figure. So it's not quite as heaps better than it was because they don't need me to tell how much the stove costs because they have a receipt. So we don't do a depreciation for that person necessarily. Anyway, just out of interest that. While we run through depreciation and other things, this is just a regular question. I'll try to just address anything that comes up for us. Insurance. Insurance payout. We seem to flood or burn in this country pretty regularly lately, and things get wrecked, and there's insurance claims, hopefully, related to those on our investment properties. If you have no insurance, it's not great. Depreciation works the same. You put new things in, depreciate the things, scrap, and we'll talk about scrapping in a moment. Remember that, scrap and claim for the old things, etc. If you do get an insurance payout, the insurance company's paid for that, and you don't actually get to claim depreciation against it. You kind of continue the same depreciation you had, right? That explains that, but the simple thing is you don't really get more depreciation based on money that someone else spent because you didn't spend it, I suppose. Just something to consider because it's a regular question about insurance. No insurance, same. Yes, insurance, someone else's money doesn't give you a whole bunch more deduction. Current business incentives. Not highly relevant to residential property investment here, but if you do run and own businesses, or we do commercial properties or any properties, can be residential properties that are owned in a business name. There's been a lot of incentives brought in over the last few years around trying to incentivise spending. That's why there's so many you can't buy a ute. Well, there's a few reasons you can't buy a ute for love nor money at the moment. They can't get any. But before that, they became an instant tax deduction for businesses. So business owners that bought a brand new ute could write it off straight away. None of this depreciated over years. It was instant tax deduction. So they brought in these rules over different times around, pre-pandemic and during and after to try and incentivise spending to stimulate the economy. And what they've done for businesses is, from 6th of October and used before 1st of 23, you can claim, if you're a business with a turnover of less than $5 billion, which most businesses in this country, including mine, well and truly, then you get to claim an instant deduction for a ute, for a plant item, for an air conditioner, for any plant items that you buy. And they even got better and went, if you get a big deduction because of that in a year when the pandemic was here and you didn't do so well and you had losses in that company, you could go back and write them off against profits from the past as well, right? So it makes a pretty big difference if you've got a business or you're able to claim these assets, depreciable assets, as a business. As residential property investors, most of the time we can't, and the structures that you do set up are rarely directly in a company because it has other issues that means it doesn't work that way for the purpose of residential property. But I'm not the specialist on the structures. I know most of the time they're not directly in companies. If they are in structures, they're usually company and trusts. But does make a big difference. I've included the tables here, which I'll run through a bit quickly, and also with the farms that you've got. If you are in business or you're claiming under these business assets, things to consider because there's some tables and you can have these tables at a later date because they're very different for different times and different types of businesses. So small businesses, pre-COVID, during COVID, after COVID, you can write off everything. There was, only $150,000 over. They started off, if you remember back to the stories, when they were talking about the truck in Parliament, the truck, they could claim the truck and they wrote a business, the outboard motor for the oyster farmer, etc., was where that started with the 30. And now we're up to anything. Small businesses, medium businesses, and large businesses, there's just different things on different dates. I won't run through all those because, but I did discuss with Konrad, you guys like detail and everything. So I said, well, I'm not going to run through those in detail because we've been there for a long time. Because the crux of it is at the moment, these will apply if you bought these assets in the past, but anything you're buying now, as long as you put in before 23, then you've got just about anything is instantly deductible. It makes a big difference to the tax deductions. Even our cars at our business, for example, little Corollas running around with BMT on them, they're instant tax deductions now, which is nice. Primary production, farms, may not be investing in farms, too many of you, but once again, if you want some detail, they've messed with farms a fair bit over the last few years. They've made it good, once again, full expensing on most stuff here, written off if it's after this date. So what they've concentrated on, and I mean, it's a nice story, I suppose, if nothing else, is with farms, we're all going to, depending where you listen to, water facilities, fodder or food storage and fencing are things that we need in order to have food, right? So they've got very generous on the claims for fodder storage as food storage and the claims for those things, and at different times over these different dates, they've done different things to it that mean farmers are able to invest in these things and claim them straight away and also can do that loss carryback. And They can do new ones and second-hand ones, and sometimes not second-hand ones. If someone bought them after, they're allowed to write them off. There's a case where that's gone through. So in 2015, they let everybody claim everything straight away. And then when someone else bought someone after someone else bought that new farm, and the first guy's just claimed $300,000 worth of fences, they don't want the next guy that buys it 6 months later claiming $300,000 worth of fences as well. So they tried to cut that out, double dipping sort of situation. And that went through a case recently, the McBride case. But most things in a farm now, and if you're a small business entity, then the rules change a little bit again, which I've given you all the doco there. But once again, I don't think we'll go through that, because if we're a room full of farmers, it'll be a little more interesting. But I leave it there because you want some detail, and also I just think it's interesting. It's good at least to try and do something for the farmers. So if you're a farmer, this little flowchart tells you, well, I bought it, do I qualify for this, do I qualify for that, blah, 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 and that's how you work out depreciation on your farm. Or that's before I do anything. That's just to work out how we treat it after we cost it, effectively. So that's in there if you've got any great interest in farming or a farm, any sort of primary production. All types of industry. So we don't just do it on residential stuff, we do it on farms, obviously. Retail stuff, anything down to things like an abalone farm here I'll just put these up because I think they're interesting also. Abalone farm, $1.5 million worth of deductions over the life of the property. Guys said that was a really interesting job to go and do. Lots of deductions in it. Marinas, close to my heart. I love boating. It's not my boat, unfortunately. Mine are on trailers, but anyway. The marina gets a depreciation if it's used for business. The marina owner uses that, so we cost up a marina. Quantity surveyors, and I say we count bricks, but at the end of the day, any component of construction in some way, we can measure how much of this timber, how much of everything, how many of these poles, and what machines we need to put it in to dig the holes in the ground and put them there, or in the water, the bottom of the water, etc. But marinas. The Melbourne Eye. I'm in Melbourne yesterday, yes. The Melbourne Eye. I've been in Canberra and Gold Coast and Melbourne this week, so I was getting lost there. But the Melbourne Eye has got a depreciation schedule we've done. So it's got depreciation, for example. Costs a lot, that thing too. Solar farms, lots of solar farms. Some of these in SA get some big dollars. They've been interesting jobs the guys have done. Older properties, what sort of deductions out of them? 2-bedroom unit here, $33,000 over 5 years. Lots of people built in 2005. And we're past this in this group now because you've listened, but I kind of keep coming back to these older properties because $6,700 is still a few dollars. Some people would have thought, nah, 15 years old, not bother. 1995, $4,500, $22,000 over 5 years. 14 years left to go for the 40 years. And it's $63,000 in claims. Lots of people would have said, old house, not to bother actually talk to the quantity surveyor about it. Commercial properties, sort of deductions there, $1.4 million, $36,000 for 1,500 square metre. The tenant and the owner of the building will have separate fit outs. So if you do run a business from a building that you own, or you run a business and you rent a lease premises from someone else, then that business and all that plant and equipment, all that stuff in there that you do, depreciation applies to it. Frequent questions. Doesn't my accountant look after that? I have a good accountant. If I had, we've done 800,000 schedules. No, I think I've heard that 1.6 million times. We work alongside the accountant. We're the cost guy. We're like the ear specialist and the GP, I suppose, that comes up with coloured pencils and estimates construction costs and tells them how much it should cost to build, and will stack in an ATO from an ATO compliance point of view if you do get an audit. We get plenty of clients audited. The department rings us and asks us questions about the report. I've never had one not stack yet, but we answer the questions quickly. And usually the questions come from someone who I question whether they know what they're talking about from the ATO when they ask those questions. It is a regular thing. They go, how did you do this? Well, I don't know, if you knew how to do it. And sometimes it's interesting. I remember having a couple of long conversations a number of years ago with the tax office and about a particular plant item. It was fire hoses and reels and sprinklers and how we cost them up for the purpose of depreciation. Then a sort of practice note come out, and it's like, I just wrote that for you. Practice note on how we treat this. I'm like, you were asking me how to do it. And that has happened in the past, absolutely. Another regular one, does a property need to be rented in order to claim it? Now, commercial here, but residential is the same answer. when your property is available for rent, it's available to claim depreciation, available for income-producing purposes. So if you're living in your house or using your house, no, it's not. Commercial properties you don't generally live in, not supposed to anyway. So commercial properties will always have that depreciation available, even if they sit vacant, as long as they're available for rent. And the test on the residential property is genuinely available for rent. So it's my holiday house and I'm trying to rent it out for $10,000 a week when it's really only worth $2,000 a week. That's not genuinely available for rent, would be the way the tax office would view that one. Nothing to do with me, I'll do a depreciation schedule for you. We'll create deductions, just whether or not you're allowed to claim them. Is it too old? In case I haven't harped on that enough today yet, I'm going to say it again and ask questions about the age. Is it too late? If you don't if you don't pay your tax, right? The tax office will find you eventually and they'll make you pay it. They'll probably give you a fine. Bad enough, I suppose they could probably send you to jail. You know, you've got to pay taxes in this country, that's the rules. They'll give you a fine, etc. It kind of works the other way in some respects. If you haven't been claiming your deductions, you can go back and amend pretty easily up to 2 tax returns. So you come here today, your mate at the pub told you had an old property, it wasn't worth it, I told you differently. You've got deductions that could be there. Even if you bought that property 3 or 4 years ago or 10 years ago, although it's harder to make it work then, if you are not claiming what you can claim and there is some deductions there, you can amend 2 tax returns very easily. So your accountant will just amend a tax return, just like they do a tax return and go, oh, there's $5,000 I should have claimed last year that I didn't. And the tax office will give you back the money, just like they do with your normal tax return. It's just silly that you left it there for a couple more years, that's all. So if you've owned it for 10 years, I've got to go and look at it 10 years ago. So if there's plant and equipment in there 10 years ago and a lot of it's written off, then it's hard. But if it's got that Division 43 and it's 10 years ago and you're not claiming it, then there's still deductions there that are going for 40 years, remember, the same amount each year. So there's some deductions potentially there. So if you've got old properties, or you've had them for some time, simple things, we'll go, there's a depreciation calculator that we've got online we'll talk about later, or you could just send me the address and we'll have a look, whichever. Start with the calculator because that's something you can do. Have a look, plug in some detail about the property. If it tells you it should get $5,000 last year and you claim nothing, may want to talk to us, see if you can get that money back, basically. Important thing is to do that before you do another tax return because you can only amend 2. So if you do another tax return the next few months and then you think, oh, we better check that depreciation, you've got to miss out one. So don't do another tax return before having a look at the portfolio and making sure you're doing stuff, claiming what you can claim. 2 years very easy. It used to be 4, they changed it to 2 a few years ago, unfortunately. Capital improvements versus repairs, like to touch on this because people think I spend money on my property, I get to claim it all, I get to depreciate it, or what do I get to do? If it's a repair or maintenance, you get to claim it 100% straight away. So the more things we can claim straight away, the better, obviously. The more of those things we can find. But if it's an improvement, you need to depreciate it. So it needs to add on to the depreciation schedule. So a fixing a fence with a few more palings is a repair. A whole new fence that's steel, that's an improvement. I don't get into the argument between repairs and maintenance and capital improvements with the accountant. Normally, we put what we think, and sometimes they want to do it a different way because I think there's plenty of creative accountants doing it different ways to whatever. But or it's whether it's creative accountants or people's misunderstanding of what's really supposed to be done. Like if you replace a hot water service with a new one, you've improved it with a better one. So it's an improvement. If you fix a hole in a hot water service, you fixed it. You claim it straight away at 100%. The rules are often a bit grey in tax, but we work alongside the accountant with what should be done there. Capital gains tax. I'd like to touch on that because I say you don't have to pay this one. I said at the start, if you remember, you don't have to pay out depreciation. It's all, really great, etc. But you do, depreciation that you claim over the time of owning the property will reduce your cost base. So when you sell the property, assuming we have a capital gain, which is what we're after, or if you sell the property, then your cost base will be reduced. So the amount of capital gains tax you pay will be increased. because you'll be seen to make more profit. Now, when you make depreciation deductions, you make them at your full marginal tax rate each year, and you get that money back in your pocket each year. When or if you pay capital gains tax, and I've paid none since 2001 yet, because I don't sell. And that's really the simple way to not pay capital gains tax, is don't sell. If I do have to pay capital gains tax, it will be at half of my marginal tax rate. So the money I've collected on the way through, I've put in my pocket since 2001, with the time value of money first, and secondly add the fact that I pay it at half marginal rate instead of claiming it at a full marginal rate, the numbers will work out that the money in my pocket's more than what I had to pay in capital gains tax at the end. Most of the time, should be all of the time. There's a new Maverick newsletter that if you're not on it, you should join it, that we write twice a year. The one that's about to hit now, next week or so, has a worked example on capital gains tax and how to treat it. And there's some intricacies around that legislation change on how you treat the plant and equipment, on how to do that. There's a good case study in there on capital gains tax and a calculation, so you can see how it's done. It's an accountant question. If you're only keeping the property for 1 year, or just over 1 year, if you want to halve your marginal rate, then you might want to work out, well, if we claim this much depreciation and have to pay this much capital gains tax, is it worth it? But if you're looking to sell the property quickly, then you ask your accountant, is it worth it? And you get him to crunch numbers before you buy a depreciation schedule from us. Even in that scenario, providing it's 1 day more than a year, when you get the 50% exemption on capital gains tax, the numbers will usually work out better because of the marginal rate thing. If you've got to pay less than a year, you've got to pay full capital gains tax, then I don't know if the numbers will work out as well. But it's a number crunching exercise on your scenario that your accountant can actually help you with. So again, I'm not an accountant, I'm a quantity surveyor. I know how to crunch them, but I know how to give you the numbers is the more important thing to help your accountant or yourself crunch them. Renovations. Now, if you're renovating, I've done a lot of renovating over time. I had no equity. I started with nothing. So I had to buy something, renovate, get some value add, reborrow the money, lots of 95% lens to get there, to drive through that property portfolio, or to build it in the early days especially. When you're a renovator, if you add things to the property, new stove, you get to depreciate that new stove, right, over time. Great. You add a new kitchen, you get it's building allowance, you get to depreciate that kitchen going forward, or claim on that kitchen going forward. Great. Pretty easy. You've got this house, you're depreciating happily away, and then you put these new things in, so there's more money spent, more depreciation. That's all simple. Important thing to consider if you are renovating is to talk to the quantity surveyor before you rip it to bits. The answer of why is because of scrapping. Because whatever you threw away, if it had a depreciable value left or a value left for depreciation, it should be instantly deductible in that year that you throw it away. Now, sometimes, especially before that 2017, you'd have these things that were a bit tied with a bit of value. I'd go in, do a renovation, throw it all away, and I might get a 10,000 instant deduction for the residual value on everything that was there in the year that you do that renovation. So before you rip it apart, make sure the depreciation schedule is in place and done, and then you'll have the values on there to write it off, or we can help you with that if you need to. It's important, do not rip it apart till you talk to a quantity surveyor, or make sure the depreciation schedule is done. With building allowance, this still works, that Division 43 component. So if you've got a property that you bought after 2017, that you don't get the plant equipment deductions, and it's 25 years old, let's say, and you want to replace the kitchen. It's quite possible to replace a 25-year-old kitchen, like it's getting tired. If you think the rent's going to be worth it and all those sort of things afterwards, or the valuation, you throw away a 25-year-old kitchen. That 25-year-old kitchen's still got 15 years of claims to run. So the residual value of that kitchen, if you throw it away, is scrappable, written off, and you're claiming whatever's left of the 15 years. So it's actually a substantial amount of the overall value of the kitchen from the start. Before you rip it apart, call the quantity surveyor is a simple answer. Tell me you are going to rip it apart, so we make sure we take enough detail to do the kitchen and all that sort of stuff is always good as well. Those things mean quite possibly some substantial deductions when you rip those things apart over that period of time, basically. It's also good that if we're doing something that's going to be scrapped, that we've been there before. tax office rings you up in 5 years and does an order on that big deduction you made 5 years ago, you'd kind of want something that someone's been there, they've got photos of it and taken all the information about it at the time. Important things to be included, and I'm going to go through a couple of those in detail. Projected for 40 years. DV and piece, diminishing value and prime cost. I was like an ET guy there talking in different language. Effective life and how long things should last. Pro rata deductions in the first year. So if you settle on the 17th of June, you've only got 3 days of claims. We need to adjust and pro rata adjust those things for the 3 days of claims. That's why we're always pushing for your settlement date and when it was. Comes in PDFs, CSVs and Excel so you can download it into the stuff. It's got a capital loss schedule for the 2017 changes that still actually puts the values on the plant and equipment, which you'll need for capital gains tax calculation purposes in some instances. If you have a K7 event or a this or a that, but we give them to you anyway. That's a whole mind-blowing how to treat that for CGT that your accountant can play with later. He might need the numbers, so we give them to him. Common areas, low value, low cost, and split schedules are 3 things I'll go through in a bit of detail because they often generate a few questions. In a common area, the way depreciation is done against these plant and equipment items, you can see the list of them. We'll stick on the fire hoses and nozzles because it's big enough to see, and it's the example to use. We take the fire hoses and nozzles, $221 worth for this particular owner in the common areas, so you get your portion of the ownership of these things in the common areas. The fire hoses and nozzles would be worth obviously a lot more than $221, but you only own one, 50th of it or 100 of it, depending on how many units in this project. In these areas, we get to claim based on the value. Anything that's worth less than $300 gets 100% deduction. Inside the unit, if you've got 6 light shades that are worth $200 each, let's say, they're seen as a set and $1,200, so you can't claim them at 100% because they're a set together. Some reason in the common areas they decide that we'll split the value first and then apply the rules. What it means is a lot of these things get claimed a lot quicker at the start. So we make sure we apply that to the deductions. People often think fire hose and nozzles, they're worth more than $300, but yours are only worth $220, so we get to claim them straight away. It gets more deductions in the early years. Also, low value pooling gets applied to these things that are worth less than $1,000 to start with, get a higher deduction the first and second and preceding years, 18.75%, then 37.5%, which is high deductions early years. These things apply to that. We'll get to low value pooling in a minute though, but no set rules, lots of deductions in the first year. If you're a taxpayer that this doesn't work for you to get it all in the first year, which I like my money now, so we try to get the maximum deductions. We can turn these things off and spread them out over the time with the prime costs as well. Low value pooling, this one creates a few questions. Anything bought for a value of less than $1,000 gets 18.75% in the first year, and 37.5% in the preceding years as a deduction, as opposed to its effective life rate, which is usually, well in this one, for example, 16.7%. That's lower than these 37s. This cooktop here has a value of $1,600. In the first year we get 270, 226, 188. That's a diminishing value, claiming the value that's left each year. In the fourth year it looks like we get 0, but it just comes to a different schedule and it gets 37.5% because it drops to a value left of less than $1,000 and we get $353 in this year. It would have only got 160 odd if you didn't do this, if you didn't apply this rule in your schedules. Lots of guys that do these don't have enough software to do that, but we do, and we drop everything in at the appropriate time, make sure it gets dropped in because 350 instead of 160 bucks is on one item only, and all these things get dropped in over their time. Low value pooling. Fair bit of detail, no? Konrad told me you love the detail. Split schedules. Here's another one to mess you up. This one's, it's not too bad. When you own properties together with more than one person, then you can sit there and go, well, you've got a depreciation schedule. I own 50% of it. I'll just claim 50% of what's on the depreciation schedule. You'd think it would be that simple, wouldn't you? But it's not. Oh, well, it can be if you want less deductions, absolutely. But in order to maximise the deductions, a bit like in the common areas, we actually get to split the value of the item first and then apply the tax rule. And the difference it makes, we're back to our oven here worth $1,600. Would get its rate of 270 in the first year, and if you chop that in half, you get 135, right? Okay, that's what it would get. If you instead go $1,600, and you split it in half to 812, it then gets low value pool, it gets 152 in the first year, 248 in the second year, it gets 135 and 113. 113 it goes to 248 because of that 37.5%. So it gets more deductions by splitting the asset first. Range hood, $468 under its normal life. Pool to get $88 in total value. You go 44 and 71 if you just split them in half the first 2 years. With a split schedule, 50-50 here, it's worth less than $100 each, $300 each. So each only gets $234 in the first year and spreading it out all over these years, right? My job, get as much money in the early years. That's one of the ways we do that effectively. Apply those rules properly. If you're 20, 20, 20 and 40, that's 100, isn't it? Yep. 20% owners, then the same rules apply. We can split it up to as many as you like. If it's in two names, we ask at the front, do you want to split schedule? Some accountants don't like the split schedules because it makes it harder for them in some ways. Split schedules have caused me more headaches than many things, but the thing is, that's the way we can do it to maximise the deductions. If you don't want it that way, you can just split it in half. I'm about how do we get the most deductions and apply all the rules we've got to do that. So that's why the split schedules exist like that. Now, making it easy for you. Firstly, once you even get a quote for depreciation schedule, we built a portal and this thing was birthed on a plane, flying back from Perth with my partner once, where we thought, what's an easy way for accountants, because I think we'd been an accountant thing, and an easy way for accountants to see the schedules. My BMT is a portal we built so that when you get a quote or a job, it all sits in the one spot, one little login that's easy to reset if you need to, when you forget your password, not if. Easy to reset based on your email address, etc. And it's a place where that depreciation schedule will sit and you can share with your accountant. The key thing, there's two key things behind it was, here's where it can live and share with your accountant. So accountants have a login, lots of accountants, I don't know, 10 or 15,000 have a login, and they will be able to see all of their clients' depreciation schedules in there. So I shouldn't ever get the, hi Brad, can I have a copy of my depreciation schedule? Because they should be able to find them in there. I still get lots of those, and I say, if you said, yes, I'll give you one. Have you seen my BMT? Because it's an easy way for the accountant to get to them. But the second reason why we want the accountant to be easy to get to it is, what if you change something? This was the other core reason behind building this. It's great I do a depreciation schedule that lasts you 40 years at the start, right? But in the 6th year, when you throw away your stove and put a new one in, I didn't know about that at the start, so I can't deal with that. I can't make it live. So an easy way for you to deal with that at no cost is you log back into My BMT, you add in your new stove, and it fixes up your depreciation number. So, you can scrap the old one and put the new one in, and then share the new numbers with your accountant that year. That process for you to do that and enter one receipt in there is easier than call me, get us to do it, fix it up, give it to the accountant, blah, blah, blah. Or the accountant uses the wrong numbers from the previous year. Because if you rip your stove out in the 6th year, then your 7th year's wrong as well, because obviously the stove needs to come out, new ones need to go in. So the numbers at my bottom of my page for the whole of the 40 years, as soon as you change something, the rest of the years, they're not wrong by much, but they're a bit wrong. So this is a way that you can easily fix them all and share it back with your accountant. Core reasons behind building it with that. It sits in there, it makes it easy. But then we thought we'd put some more cool stuff in there for you, I suppose. It's free, and investors like free stuff, right? And most of them, they cost me to build, but don't cost too much money. It's part of the deal. Core things that, but we put some other things in there where you can track your income and expenses. So you can, and I think I've got photos of these after now. I talked about them all, but anyway, some pictures. I'll show you in a second. There's a spot where, and people have used this, we didn't even advertise it or anything, where you can, as you get your receipts, you just enter them in there, and it's in the format the same that the MyGov ATO things where you do your tax return, brings in your depreciation number because that's in the same system there, and you can enter your rent and your interest and all that stuff, and then hit share on your accountant, and instead of your shoebox of receipts, it's there and it's in the format ready and easy for your accountant to use. Hopefully makes your accountant's job a little bit easier. You can upload your photos, receipts, and the other thing is we've got some market data. And this one does cost me a little bit, we've got the planning applications downloaded in there. So if you've had a BMT schedule and your investment property, you'll set a radius around it, and if someone puts plans and permits to council to build something in that radius, it'll actually send you an alert. You can go in and you can see that someone's building a 30-storey high-rise 4 doors up the road from my investment property. Might like to know about that. But it's a way to actually see those things. That I actually put a DA in a property of mine last week, and it popped up in my BMT to tell me there's a DA gone in, which was great. I knew about it already, but it did pop up and show that there. So that you can set it and it'll spit out emails to tell you that things are happening around your properties. I've got a few properties, so I get a list now each time they come out of, everyone's building stuff around my stuff. The other thing we've got in there is an AVM. And I heard some discussion about an AVM out the front there. The AVMs, and these come from Insight Data, which is now owned by Domain. And when the banks go to do the valuations to start with, the first thing they may look at is called an AVM, or an automatic valuation. And these guys are one of the ones that do those for the banks, and we've got access to the same data. So around the investment property only that you've had a depreciation schedule done on, you can see those AVMs, the latest of the AVMs that sit inside my BMT. So if you've got one done there, you can see those. And if you have one in the past and you're not hooked up to this, we can still hook you up and it's still free, and you can go and see those if you've already had a depreciation schedule from us. Now it'll show you how it all works, even though I've explained it. You can see your status, you can get access to all your schedules and see them in one line. You can add all your income and expenses, as we said, and that's in the same format as the ATO. I put new carpet in for this much at this price, and it fixes it up and sends you a new schedule to the accountant, which is kind of handy. Easy for him or her, and easy for you. Look at the actual year. There's some tailoring that can go on here, and how much deduction for Division 43 and all that sort of stuff. Pooled plant, you can see we have all these terms that we've learnt today are in there somewhere. And the other thing that's inside my BMT as well, it's also an app that's free that I think coming back to the core, crunching your numbers when buying an investment property at the start that we did a couple of times. PropCalc app, free. You can actually do the exercise that we did there yourself very easily. So even if you enter the address into that you're looking at, it even drags some of the median data for rental prices and things into there, etc. But you put your rate in, your interest rate you think you're going to pay, how much you think you're going to pay for property management fees and insurance and all that sort of stuff. It drags some approximates to start with, but then adjust it and tailor it to the one you're looking for and put all these things in through here, and it'll spit you out it'll actually estimate a depreciation for you if there's enough data in the background. If not, you'll have to go into the depreciation calculator, enter the age of the property, a couple of things, and it'll spit you out a number. And then it just does what's the holding cost? And you can do some comparisons. I'm looking at this property and it costs this per week and this per week, and what some stuff about the median prices and information in the suburbs effectively. That's free, it sits in the MyBMT there. You don't actually have to have a property to use MyBMT, by the way. You can get into that without that. You just don't have any AVMs or any of that cool stuff because you've got no property or no depreciation schedule done by us. How to do it? All pretty easy. Or when, I suppose, to first. You don't, before you buy, you need to come up with some of those numbers to crunch. You might need an estimate of how much deduction that might be, which you could get on the app or get an idea, or on most projects have got a estimate of some sort of depreciation of what might be available that we may have done for developers or guys selling them a lot of the time. When you settle is when you need to think about depreciation, because that's when money becomes available. Or actually, the next time you do a tax return is when the money becomes available. Unless you can actually look with your accountant to have a form done each year where it actually gets your employer to take less tax out of your income, because there's going to be a big deduction at the end of the year. So talk to your accountant about that one if necessary, and then you may need that schedule in order to do those numbers straight after you settle those. Tax time, or renovate, or before you rip it apart is the other time that you may have to think about depreciation. We talk to you about the property, we make sure it's worth it. We then go to site. Something that's been pretty interesting in the last 2 years especially, there's always been quantity surveyors out there that have said, we don't need to go to site, we'll just send us a few photos, or I'll look at realestate.com, or I'll measure it off Google Maps, etc. We always, so my staff are spread around the country, we always go to site, they're always my staff. I don't contract any of this out to guys that we just, send out to do something. Or to take a few photos and fill out a form. We build an app they do it on. It makes it nice and simple and downloads straight into the system to do the job. Important part of the process because we get everything. We don't miss stuff. We also are not scared to put it on the line of maximise the deduction because construction cost, everything we find, the more the construction cost, the more the deductions. If we don't go there, we don't find things. Through the pandemic, what happened was much of our industry decided they could measure it off Google Maps and do it easy, and there's enough information available. We've stood firm on that. We've got backing with the National Tax Accounting Association, the Institute of Quantity Surveyors, that's the way they like it done. And how can you really estimate properly if you haven't been and seen what's there? You can do conservative work, yes, but I'm not here for conservative work. I'm here to maximise deductions. So we had, 6,000 or 7,000 depreciation schedules that needed an inspection once the last lockdown finished. It was a bit of a nightmare. And everybody rang up the next, not everybody, heaps of people, it's open now, can you do mine? Yes, you and 6,000 others. So the backlog this year has been a little bit painful. Running business where we do this has been painful as well. But out of 100,000 properties we looked at through that period when we still inspected and it was hard, quantity surveyors will go, well, we can do it off Google Maps, or we've got data because of when it was originally built, which I've got more than anybody because I've done more than anybody. We found that on these ones, there was the 100,000 that we did in that period. We went, let's have a real good look at it. And we did this on 100,000 jobs. 66% of them had some sort of qualifying renovation works done to them that wasn't original. If we didn't go to site, we would have missed it because we wouldn't have known. Most of the time, may have picked some of that up from photos, etc. But if I used the original cost of that building that was built 15 years ago, and because I did it back then, which is quite possible, I would have missed those renovations, missed that work and missed out on the deductions. So we're believers in doing that. It's not the easiest way, because if I didn't have to have guys driving around to visit them all the time, that would make my life easier. But I guess what we've had is, in our industry, because it was easy to do it that way, people have gone, well, I don't need to. And you know what? You'll get less deductions because it's not thorough. That's been an interesting debate amongst our world, I suppose. Do it properly for a couple of extra bucks. For a couple of $100 discount, I don't think it's worth missing out on the deductions that would be there if you don't do it that way. Simple free resources, depreciation calculator app. It's been around for a long time, that one. You can go in on any property you've got, put some detail about it. It'll spit out an approximate depreciation number for you. Look at your tax return for the last 2 years. So if there's a difference, if there is, you might want to give us a call. Or anything you're looking to buy, that's the simple one to use. Prop calc we talked about, we've got some others. Replacement costs for insurance, rep cost. You need to insure your property for an amount of money when you buy it, right? Your house there, you need an insurance amount. There's a way to calculate an insurance amount that you should, you enter the square metres of it, it spits out an insurance potential number. We do actually do a bit of house and contents and landlord's insurance as well, which is on the back of that because we've got some actual costability to do that. It's not what we're here to talk about today though. Rate finder resi rates. Remember we talked about things that have got an effective life, and the dishwasher in the example has an 8-year effective life. So the tax office puts out what those effective lives are. Dishwasher 8 years, carpet in residential premises 10 years. There's about 170 items in a residential property that have got an effective life that we claim depreciation for. So you can search around the tax office's website, good luck, and find those 170 items. But we just made them into an app really simply so you can find them. You're like, why do I need that? I get a depreciation bill already, Brad. Well, the time that it is so for interest sake, I suppose, and also for if you've got a property and the tenant damages things, when you go to VCAT, or depending what state you're in, when you go to argue about who should pay for it, I suppose, that's probably the easiest way to put that. If in the dishwasher scenario, not that I should bust dishwashers tenants very often, but if the dishwasher was wrecked by the tenant and it was 4 years old, they would usually use that same effective life to say, well, it should last 8, it's lasted 4, they wrecked it, you pay half each. So if it was 6 years old, 6 and 2, that app has all those rates there. So property managers use that quite regularly because when they go to VCAT, that's how they find out what the effective life of the item is, right, from resi rates. Rate finder, If we get to everything else, like all those other, things that there's about 6,000 items in total, from your photocopier to your car to actually, in the last couple of months, they make a few changes to these things. They've added casino assets, like the roulette wheel's got an effective life now, and there was a lot of horse training assets, like horse rugs have been added. I don't know, maybe there's a lot of gambling going on in the tax office. That's not depreciation required for tax office stuff. There was salt farms as well, not just those things. Construction cost calculator. There's a construction cost calculator we've got on there. So we publish some construction costs. We put them on the back of the Maverick newsletter. Comes out twice a year. That app, you can enter the square metres of something you think to build, the quality, etc. And obviously it's fairly generic because it's based on minimal information, but gives you some idea of the ever going forward construction costs at the moment. Education key. You've sat through a decent session on depreciation there and lots of technical stuff. There's money there. Call a coin surveyor first. The things that you need to remember out of today are mostly around, I'll probably still gets it. Don't do another year before you miss out. Call a coin surveyor before you rip it apart, blah, blah, blah. Those sort of things. Like the key things to consider, but the simplest way to keep up to date. And there's lots of past case studies on, so the new one's on capital gains tax. It's not the first time we've done one in Maverick. Scrapping examples, things around effective life, and if I put floating timber boards instead of tiles, for example, there's high deductions on the floating timber boards because they're plant and equipment, not part of the building. There's case studies and all that sort of stuff on the previous editions of Maverick. So if you're not on that, join it. Covered most of this stuff. Don't outsource the inspections. I think it's an important part of the process. My guy turns up in his BMT Corolla, it's GPS in it. I know when he pulled up, I know when he left, and all that sort of stuff. We turn up on time for the tenants, or we ring, all that sort of things. We think they're important as well. Do them all over the country. The fee's tax deductible. Double fares fee guarantee we talked about. So don't fear that we're going to do it and you're not going to get some money. And obviously we need to be compliant with the ATO and what we do. And I think that's our detail on tax depreciation for today. Thank you very much.
Alrighty, and we're back. I hope you enjoyed that video. It's quite amazing. Brad's very detailed. Look, I use it myself for all my properties. I actually don't use any quantity survey apart from BMT, QS, and all my clients, I would say 95% of my clients use BMT quantity surveying. It's an amazing company. If you mention my name as well when you're ordering a depreciation schedule, say you're working with Konrad Bobilak and Investors Prime Real Estate, you're going to get a discount of, I'm not sure how much it is now, probably $100 or so. I think the average depreciation schedule will cost you between $750 to $850. So they will throw in a discount just for mentioning my name. I don't get any kickback for it. I've just known Brad for a long time, pretty much when he started the company, when I had no silver hair. And he also contributed a chapter to my book, which is Australian Real Estate Investing Made Simple, which was really, I had to twist his arm to get this chapter in, because I don't think a lot of these people are not used to writing chapters, and they're not really published authors. So it was a really challenging thing for a lot of these guys, but I managed to twist his arm, and he contributed an amazing chapter for my book, and I'm very thankful for that. So I hope you enjoyed the presentation. And remember, the key thing is that we're trying to emphasize here is not how much you make, but how much you keep that will determine your outcome and your success for generations to come. We're here to leave legacy portfolios for our future generations. So once again, I hope you picked up the main distinction from the video, which is the difference between the rich and the poor, which I covered it just before the video started. The poor work, they pay taxes, and they get paid after they pay taxes. Then they spend 100%, or they try to invest, they use credit, and they just complain and say, it's too hard, can't do it, can't be done, you can't make bloody money in this market, blah, blah, blah. The rich are smart. They use the system to their advantage. And the biggest distinction between the rich and the poor is they make money, they get paid, and they buy investments with their pre-tax dollars, which is the main distinction. And whatever is left over, then they pay taxes on, and they spend. That one key step has all the difference in the world for long-term wealth generation, which is very important. Let me give you an idea. This is one of the cheapest properties that I've sourced for my clients. As an example, in the video, this is in Mornington. It's a 2-bedroom townhouse, 695,000. That's selling actually next month. And you can see the difference on the left-hand side. Without a depreciation schedule, For a person who's making, who's paying tax at 37%, you're looking at negative $77 per week. With a depreciation schedule, just one little thing, which means that you're paying for this property with your pre-tax dollars, it's cash flow positive by $11 a week. So it's either $77 a week negative or $11 per week positive, which is a difference of $88. A lot of the people that have bought this property, these entry-level 695 townhouses, are single people on $120,000, $130,000 income, or couples on entry-level incomes with one house, just trying to get into the market. And it's a really good starting point. Mornington's always done really well. It's a destination for a lot of people to retire in Melbourne. It's a great sea town in Melbourne, beautiful there. Another example here, Port Melbourne, 1.425 million, 3-bedroom townhouse, a typical bread and butter townhouse that I source all day long. Port Melbourne, Albert Park, Middle Park. This was sourced quite a while back. And once again, depreciation schedule, same marginal tax bracket of 37%, negative $183 per week for this particular person, or cash flow positive by $9 a week. So if you just think about it, difference is $192, but it's also a psychological difference. See, when you're buying properties, the number one thing that I'll try to do with my clients is to get them into 2 or 3 properties where between the taxman and the tenant, they're not contributing anything to the property. If you structure yourself correctly, your number one goal as an investor, let's say you're on 140 grand a year, is to get your tax down to 0. And then once your tax is 0, then you buy properties in trust, because you might as well buy in trust because you haven't got any tax deductions anymore against your personal income. And the difference between buying in a trust versus your personal name is that when you buy a property in a trust, you can't offset losses against your personal income. You can only offset losses against the income the trust is receiving, which is the rental income from the tenant. And also, you don't lose your deductions that can accumulate in the trust as well, and start being claimed when the property is cash flow positive. Most properties take 6, 7, 8, 9, 10 years to become cash flow positive, depending on when you buy in the property cycle and the rental cycle. But this is a huge thing psychologically. Imagine this: you're buying your first property and you're still going to spend $200 a week out of pocket, right? Now, it's not a lot of money, $200 a week, but it's still $200 a week, right? And it's still psychologically, there's an association with an expense. There's some level, there's a level of pain associated with $200 a week. Or you're getting $9 more in your bank account. I mean, I know $9 is a cup of coffee and a I don't know, croissant or something at a cafe, but it's $9 extra that you didn't have before. And psychologically, you're linking pleasure towards property investing and accumulation. And that's the key. See, a lot of this stuff is just psychological games. You know, it's not about the mathematics. Yes, you have to know the numbers. You've got to know, you've got to be sound in mathematics, but it's the psychology that makes and determines whether you become successful in property investing or not. I also encourage you to jump onto BMT Quantity Surveying website. There's an amazing calculator you can use to get an estimate for depreciations on different properties, irrespective of how old they are. So play around with that. Definitely recommend you get a quote from them. It's 1300-728-726. You can just get a quote for free, you know, and it's the best depreciation schedule company in Australia. I could recommend anyone. By the way, I don't get a cent from them for recommending them, just so you know. We just do it because they work. They work very well. They're efficient, and they are my favorite quantity surveyor in Australia. That's it from me on depreciation schedules. I think between Brad and myself, we've covered that topic extensively, and you get the gist of it. And by the way, I always say to people, you don't need to become a master of every topic that I cover on my YouTube channel. You know, a lot of people waste a lot of time thinking they have to become an expert on depreciation schedules and trust and lending. Look, you don't need to. You just need to become like a generalist. You got to have a gut feeling about every topic. And so what I usually use is the analogy for property investors. The property investors are like general practitioners. They don't specialize in an area. They just know a little bit about everything, but they know who to go to and to refer people and to ask questions from the experts. And that's what you're doing as a property investor. Like a general practitioner, you know a little bit about depreciation schedules, a little bit about how to find best properties. But when you really want to put it all together, you get the experts together. You use Brad Beer for the depreciation schedules. You use James Black for the accounting. You use a good financial planning company. You get a lawyer to vet your contract of sale. If you want to source properties yourself, you can source yourself. If you want to come to me, I can source properties for you. You know, and I'm the expert on Melbourne, obviously, a high end and blue chip. So if you use that, you've got to have a general idea about things, but by all means, don't feel like you have to know everything about depreciation schedules or finance or accounting or trust deeds, because you can't replicate these careers. I mean, these guys are experts in their field. It will take 20 years for you to master one of these areas. I've been doing this now. I've been in lending and financial service sector for 25 years now. I'm 48. I started when I was 23, and I'm still learning. But it took me 2 decades plus to really master property sourcing and understanding in the Melbourne property market. You don't need to replicate my career, guys. You can just go to me and ask me the right questions, and I'll help you succeed. I mean, it's that simple. Now, for those of you who want to buy and go to the next level and you're interested in learning more, and I can tell you now, the best dividends you're ever going to get is your personal development and how much you spend on your psychology and personal development. Remember, traditional education can make you a living. Personal development will make you a fortune. And this is what personal development is, which is the Property Portfolio Accelerator Summer 2022. It's a recording from 22 over 4 days, and I've condensed it down into 30 hours of contents, 10 speakers, plus a manual. It's the essential blueprint for people who want to build large property portfolios, the kind of property portfolios that can replace your income, give you the financial freedom that you truly deserve, and leave a legacy for future generations, whether it's your kids, grandchildren, or charity, or a cause that you believe in. Now, the actual home study online video course is normally $4,997. But what I'm going to do is, because you're here and you're on my YouTube channel and you've watched the video to the very end, I'm going to give you a massive discount reward. Now, normally the course is $4,997. You also get an hour consultation with a top mortgage broker. So when you watch the course, each speaker in the actual video course gives you their company details, and there are forms in the actual manual that you can fill out, or just contact the company directly and set up a 1-hour strategy sessions with each speaker. So you get an hour session with a mortgage broker, with a property accountant, property solicitor. You get a depreciation schedule discount of a minimum of $55, and they range in price, by the way, based on postcode. So you've just got to get a quote. And also you get a special offer on all future building inspections. You also get both of my books in digital format, which is my Australian Real Estate Investing Made Simple book and Australian Property Finance Made Simple book. So total value is $5,531.95. And these are the speakers, by the way, who are there. And so Stephen, who's also an amazing property investor, MCs the whole event. Cameron Fisher is a valuer. He runs the property management division, 45 years in real estate. He's been a director of some of the biggest real estate agencies in Australia. I talk about property sourcing and how to set up your whole property portfolio. Stephen McClutchy, Director of Loans Australia, has settled over $1 billion in lending over a career of spanning nearly 30 years. Very successful property investor here in Australia and in America. I've known Stephen now for 25 years. It's crazy. We laugh about it, but it's a quarter of a century. And I mean, it's insane when you think about it. I feel old when I think about it. But I actually met him when he set up his company, and Stephen's the only person that I know. He's never worked for anyone in his life. He just finished uni and go, right, I'm setting up my own company, and he set up Loans Australia, and here it is. I don't know anyone that has done that. James Blake from Branding Co. He's a director of Branding Co. Accounting. Very creative accounting group, out of the box. They have hundreds of investors and developers that they look after. James as well is a property investor, very successful, multi-millionaire, very switched on. And the list goes on and on and on. So you want to make sure these are the guys you want to get together with and to build your wealth. You also get both of my books, and you get a course manual as well, download it as PDF. And I encourage you guys to get the PDF manual and go to Officeworks and get it printed and use it as a manual. You know, it's a very simple online video course to watch. You just log in and you click on each video. It's literally that simple. And it's, look, it's not a fancy Hollywood production. It was in a hotel. We spent over $96,000 on this event. So we have professional camera crews and sound, but it's there to just educate you and give you the essential knowledge that you need right here in Melbourne to build large property portfolios. And it's not based on stuff from America, or there's some kind of hype or stuff that worked 20 years ago. We're talking about stuff that people are doing right now in the market, where they're buying, how they're structuring themselves, where they're getting the money from, right now in Melbourne, right live. And these people have real clients. They're not academics, guys. They're not theorists. I want to stress that point because, these are not people from Monash University who have never done anything and they just lecture. These are guys that are actually doing this with real investors all day long. So we're going to give you real practical information. It's normally $4,997 plus the bonuses. But for anyone that's interested, because you've watched this YouTube video and you just got to click the link below, you get it for $997 only by going to the link below. You can't get this offer anywhere else. So for $1,000, guys, for it's insane. It's $1,000 for 4 days worth of content. If you work out the hourly rate just on the lawyer, for example, it's like $450 an hour. I mean, you got 3 lawyers at the event. One talking about wills, estate planning, one talking about testamentary trusts and contract law, and Pasha talks about how to fix your credit file. Just those lawyers will cost you $1,000 if you sit down with them. So it's $1,000 of probably some of the most up-to-date, state-of-the-art property investing information that you can get your hands on. And it took me a long time to put together. I'm very proud of it. I've had massive amounts of very positive responses from clients who are blown away with the contents. So it's $997. When you click on the link below, you end up on this website, and then you can just go and buy it, access it immediately. And I've got a 100% money back guarantee. Open. If you watch it all the way to the end, if you don't like it, if you think it was BS, whatever reason, we'll give you your money back, no questions asked. I don't care what the reason is. So I believe in the product 100%, and I stand by it 100%. Anyone that knows anything about property, when they watch this, it will take you to the next level, guys. It is just that simple. So I encourage you guys, for those who are serious about building wealth, and if you can't make it to my live Melbourne events, get this online video course. It could make the huge difference, even in just how to restructure your mortgage and pay it down sooner. I mean, this could be life-changing stuff for you. So that's it. Final thing is, if you want to have a strategy session with me, if you're interested in building wealth passively and you want a sourcing specialist like myself to work with you one-on-one, and all I do is I source properties in Melbourne in the highest capital growth suburbs in Melbourne. So Melbourne's got 321 suburbs that are established. It's got 197 house and land estates on the outskirts of Melbourne, right from your Point Cook, Truganina to your Roxborough Parks, and South Marangs to Berwick's Pakenham. I don't deal with house and land estates. So 321 suburbs that make up Melbourne. I only source in the top 100 highest capital growth suburbs. And there's 12 suburbs that are going through gentrification. Gentrification meaning they're rough, they're kind of high crime, low income demographic, but they're very close to the city, like Glenroy, Sunshine, Heidelberg Heights, Heidelberg West, where they've got the right ingredients to become normalized suburbs of the future, maybe even upmarket, but at the moment they're still rough, but they've got a lot of opportunity for growth, and they're cheap to get into, as long as you know what to buy and how to buy it correctly. So if you want someone like myself to help you building your wealth, by all means, get in contact with me and have a free 1-hour Zoom call. It's free. There's no strings attached. Basically what I do, I sit down with you, work out where you are, where you want to be, and then give you a feedback. So we take an idea into a plan, and I'll show you how you can take it into implementation stage. But remember, if you fail to plan, you plan to fail. So you've got to have an all-encompassing investment plan to take you from where you are currently to the next level. There's so many people that waste time going from A to B, wasting years, buying the wrong properties, and then selling them at the wrong time, and then coming back to square one. It's such a shameful. It's a shame that it happens, because they're smart people. They want to do well. They just don't have the right people guiding them. So if you want to stop wasting time, and time is, by the way, the only thing that you never get back. You can always get more money, guys, but you can't get more time. Time is always finite and always running out. If you want to go from A to B, and you have the means to do so, which I'll talk about in a second, then this is definitely for you. It's definitely not for everyone, because if you want to do renovations, subdivisions, I can't help you. This is purely buy and hold blue chip. It's an hour consultation where you walk away with a real clear understanding of your strategy and what's relevant to you. You get the whole team as well. And the team changes, by the way. This is just from one event. I've got 6 accounting firms that I deal with. I've got 3 mortgage broking companies that I deal with, as well as banks. I've got many property managers. So there's a whole array of experts that I can put you in contact with all around Victoria that I have access to. But you get a real strategy. You have a very good clarity about what's possible for you, what you can do, what you can't do. And it's a step-by-step kind of a blueprint that you can walk away from. The minimum criteria is I don't source anything under 700,000. So you need to either get a pre-approval from a bank for 700,000, like 695 is the cheapest properties that I'll source, which are 2-bedroom townhouses, basically in good areas like Box Hill, Bentley. They're all over the place. So if you're a single borrower, you need, if you haven't been pre-approved, by the way, I've got access to brokers, just come and see me. But roughly you got to have an income of about 95, 100,000 and about 112,000 in savings or equity. If you're a couple, and you need to be on 140, all you got to do is email me directly, Konrad@investorsprime.com.au. If you've been to a live event, send me that form, and then I'll respond to you personally, and I can lock in a mutually convenient time we can catch up on Zoom. I hope you enjoyed this video, guys. I know it's depreciation and tax. I know it's a bit of a dry topic. I wanted to make it as exciting as possible. And that's it from me, guys. Thank you very much. This is Konrad Bobilak. I'll see you on the inside.